The economic crisis in Sri Lanka worsens day by day. The latest, the country today announced that it is defaulting on its all external debt worth $51 billion.
After years of robust growth driven by oil and cheap credit, Ghana's economy is facing a crisis.
There's real inflation at over 130%.
Now, residents in Argentina are struggling to survive as well. Inflation is set to hit 100% this year.
So 2022 was a rough year, one of the worst in the past 3 decades. And with the euro area starting 2023 in a recession, and predictions suggesting that the US will end the year in one, 2023's outlook for the global economy looks very bleak. What's more concerning is the outlook for those countries located outside the global north. When we look at emerging markets, we can see the real pain that they face. Developing nations, commonly referred to as the third world or those from the global south, are facing a catastrophic debt crisis in the coming months. Rapid inflation, slowing growth, rising interest rates, and the strengthening dollar is creating a crisis that could set off a wave of messy defaults and inflict economic pain on the world's most vulnerable people. Third world countries owe as much as $200 billion to wealthy nations, multilateral development banks, and private creditors. Rising interest rates have increased the value of the dollar, making it harder for foreign borrowers with debt denominated in US currency to pay their loans. Defaulting on a huge amount of loans would send borrowing costs for vulnerable nations even higher and could spawn a major financial collapse. The World Bank projected this year that about a dozen countries could face default in the next year, and the IMF calculated that 60% of low-income developing countries were in debt distress or at risk of it. This is not good, as these economies account for about 40% of global GDP, so defaults within these nations would be significant. At least 15 of the 72 emerging markets in a Bloomberg index, including Ethiopia, Pakistan, and Tajikistan, now have dollar debt trading at distressed levels. Governments in developing countries need to refinance $215 billion of debt coming due in the next 2 years, but many can no longer borrow.
Well, out of the frying pan and into the fire. That's how Sri Lanka's energy minister has described the country's deepening financial crisis, its worst in decades. On Tuesday, the Prime Minister said talks with the International Monetary Fund to revive the economy are more difficult and complicated than before because the country is bankrupt.
Last May, Sri Lanka defaulted on its overseas debt amid political upheaval and human suffering. The country is awaiting a $2.9 billion rescue by the International Monetary Fund. Lacking resources to buy even essentials like fuel, the economy is falling into an ever-deepening abyss. The poverty rate has doubled in 1 year. Food price inflation was over 85% in October, and acute shortages of foreign currency mean that many imports, including essential medicines, are scarce and unobtainable. Also, Ghana, with debt interest payments eating up more than half of government revenues. Ghana has asked the IMF for a $3 billion bailout, a proposed debt restructuring that could involve losses of up to 30% for foreign investors, and is planning to barter some of its gold it produces for oil. The African nation isn't the only one in great distress, with 15 of the 72 emerging markets now have dollar debt trading at distressed levels. In the last few months, the US dollar has strengthened to a 20-year high against a collection of foreign currencies, spelling more trouble for heavily indebted emerging markets around the world. The stronger dollar makes payments on loans owned in US currency more expensive. This comes as lower income countries face mounting economic problems, and others, including Sri Lanka, Lebanon, and Zambia, have already defaulted on their international debts. A couple months back, Argentina slapped sweeping new restrictions on imports of everything from whiskey to software to consulting services to try to contain inflation that's running at over 70%. The South American nation has now been hemorrhaging foreign currency, and the strengthening US dollar threatens to make that worse. In July, the value of the Argentine peso fell to a record low against the dollar on the black market. As you can see with this graph below, inflation has ramped up significantly over the past few months due to the strengthening dollar. Another thing making 2023 different from global economic crises before is the role of China as a major lender. A significant portion of debt now owned by low and middle income countries is owed to Beijing. Negotiating debt relief with Beijing is unknown territory, not just for individual countries, but for the broader international community. Traditionally, the IMF and the so-called Paris Club of wealthy nations play a significant role in restructuring distressed debt, but so far Beijing has preferred to deal with its boroughs on its own. Current global economic conditions are going to lead to a lot of pain in low and middle income countries. The pain is going to be even worse and could drag out even longer this time because of a lack of global cooperation to